In less than 12 hours, something happens that we have been waiting for since February 15th. Shanghai reopens. The Shanghai Futures Exchange and the Shanghai Gold Exchange, both dark for 8 consecutive days during Chinese New Year, come back online. And the first trade that prints on Monday morning, February 24th at 9 a.m. Beijing time, is going to tell us something that no analyst opinion, no bank forecast, and no Western paper market can tell us. It is going to tell us what the world's largest physical silver buyer actually thinks silver is worth right now. Not what COMEX says it is worth. Not what the falling knife narratives say. What China, the country that consumes 70% of global industrial silver, is willing to pay for real metal. Before Shanghai closed on February 14th, the premium that Chinese buyers were paying over COMEX spot was between $6 and $10 per ounce. Let me be very specific about what that means, because this is not a theoretical number. On December 24th, 2025, the Shanghai Gold Exchange physical silver price closed at $78.49 per ounce, while COMEX was trading at $70. That is an $8 premium. Physical silver in China, the metal you can actually touch and take delivery of, was trading $8 above the paper price in New York, and that premium was not a one-day anomaly. It persisted for weeks. By early February, before the Chinese New Year closure, the premium was still in that $6 to $10 range according to multiple independent sources tracking Shanghai pricing. Now let me explain why that premium exists and why it matters so much. Shanghai operates on physical settlement. Unlike COMEX, where less than 1% of contracts result in physical delivery, and the vast majority are speculators seeking price exposure through paper, Shanghai requires actual delivery of silver bars. When you trade on the Shanghai Gold Exchange AGT plus D contract, you are trading real metal, not a derivative claim on metal that might or might not be delivered. That means Shanghai prices reflect genuine supply and demand for physical silver in the world's largest consuming market. COMEX prices, by contrast, are influenced heavily by speculative positioning, algorithmic trading, and leverage that has nothing to do with anyone's actual need for physical silver. China consumes approximately 70% of global industrial silver. Solar panel manufacturing, electronics production, electric vehicle components, AI data center infrastructure, all of it requires silver. And China dominates global production in every one of those sectors. When Chinese industrial users need silver, they are not calling their broker to buy SLV shares. They are standing in line at the Shanghai Gold Exchange to take delivery of physical bars because their factories cannot run without it. That industrial demand is what creates the structural premium. Chinese buyers are willing to pay more than COMEX spot because COMEX spot is a paper price that does not reliably reflect the cost of actually securing physical metal when and where you need it. Here is what makes the February 24th reopening so significant. For 8 days, COMEX has been trading silver with no Eastern physical buyer to push back. Every bearish narrative, every falling knife warning, every margin hike, every short seller positioning for lower prices, all of it has operated in a vacuum where the largest source of physical demand in the world was completely offline. COMEX silver dropped as low as $75 during parts of that window. In the entire time, we had no way of knowing whether Chinese buyers agreed with that price or whether they would have been bidding it higher if they had been active. Tomorrow morning at 9 a.m. Beijing time, which is 8 p.m. Eastern on Sunday night for those of us watching from the United States, Shanghai prints its first trade. And that trade will answer a very simple question. Does the $6 to $10 premium reassert immediately, confirming that the 8-day COMEX-only window was artificial and that Eastern physical buyers still value silver substantially above where paper markets priced it? Or does the premium collapse, confirming that the correction from $121 down to current levels was legitimate and that physical demand has genuinely weakened? Let me show you why I think the premium reasserts, and why I think it might even widen. First, nothing in China's industrial demand structure changed during the 8-day closure. Solar panel factories did not shut down. Electronics manufacturing did not stop. Electric vehicle production lines did not halt. The demand that was creating the $6 to $10 premium on February 14th is still there on February 24th. In fact, it is likely more urgent now because those manufacturers have been unable to source metal through their primary procurement channel for 8 days. When Shanghai was closed, Chinese industrial users could not use the Shanghai Gold Exchange. They either had to source through more expensive channels, draw down inventory, or delay production. All three of those scenarios create pent-up demand that releases the moment Shanghai reopens. Second, Shanghai Futures Exchange inventory has been in a documented state of stress for months. SHFE silver inventory has declined 75% year over year, according to data published by SEC Data. That is not a 10% draw. That is not a 20% draw. That is a 3/4 collapse in available inventory at the exchange that Chinese industrial users rely on. When inventory is that tight and you close the market for 8 days, you do not reopen to lower premiums. You reopen to higher premiums because the entities that need metal have been unable to get it, and they bid aggressively the moment the market opens. Third, silver went into backwardation in China before the closure. Backwardation means the spot price, the price for immediate delivery, is higher than the futures price for delivery in later months. That is the opposite of a normal, well-supplied market. In a normal market, future delivery costs more than spot delivery because you have to pay for storage, insurance, and financing over time. When spot is higher than futures, it means buyers need the metal right now more urgently than they need it later. They are willing to pay a premium to get it today rather than wait. That backwardation condition existed in mid-February before Shanghai closed. It has not been resolved. It has been frozen for 8 days. And when you unfreeze a market that was already in backwardation, you do not typically reopen to lower prices. Now let me address the bear case because I want to be fair to both sides. The bear argument says that during the 8-day closure, COMEX prices fell and global sentiment shifted bearish. Chinese buyers are rational economic actors. If they can see that COMEX is trading at $78 while they were previously paying $84 to $88, they are not going to ignore that. They are going to adjust their bids lower to reflect the new global price environment. The premium might return, but it will be smaller, maybe $2 to $4 instead of $6 to $10, because the fundamental repricing that happened in Western markets during the closure was legitimate and Chinese buyers will respect it. That argument has merit. I am not going to dismiss it. But here is why I think it is incomplete. Chinese buyers do not just look at COMEX prices. They look at physical availability. And physical availability during the closure got tighter, not looser. The Perth Mint still has a 6-week backlog. U.S. Mint sales in January set a record. Physical premiums at dealers in the United States and Europe have not compressed despite COMEX falling. If anything, the gap between paper spot and what you actually pay for a silver eagle has widened during the correction. That tells you physical demand is not weakening globally, it is holding or strengthening. And if physical is tight in the West while COMEX is falling, Chinese industrial buyers are going to interpret that as confirmation that the COMEX price is artificial, and that securing physical supply requires paying above paper, regardless of what paper does. Here's my specific prediction for what happens Monday morning. Shanghai reopens and the first trades print between $85 and $90 per ounce, which represents a $7 to $12 premium over current COMEX spot of approximately $78. If that happens, it confirms that the 8-day window was a manipulation opportunity that Western paper markets used in the absence of Eastern physical buyers, and that real physical demand never validated the lower prices. If Shanghai opens below 82, meaning the premium compressed to $4 or less, then the bear case strengthens, and we have to reassess whether the correction from 121 was more fundamental than I have been arguing. But here's what makes me optimistic about the $7 to $12 premium scenario. We have seen this exact pattern before. Every previous Chinese New Year closure in recent years has produced the same dynamic. COMEX pushes lower during the closure because there is no Shanghai bid to absorb selling. Then Shanghai reopens and the premium reasserts within hours, erasing part or all of the closure window decline. The pattern is documented, it is not speculative. And the entities executing this pattern, the Western banks that sell paper silver during Shanghai closures and then cover before Shanghai reopens, they do this because it works. They do it because they know the premium comes back. If they thought the premium was going to collapse on reopening, they would not bother covering their shorts before Monday. They would let Shanghai open, watch the premium collapse, and cover at even lower prices. The fact that historically we see short covering in the final sessions before reopening tells you the smart money expects the premium to reassert. Now let me connect this directly to COMEX First Notice Day because these two events are not separate stories. They are the same story told through two different data points. Shanghai reopens February 24th. COMEX First Notice Day for March contracts is February 27th, 3 days later. March open interest represents 429 million ounces in paper claims. COMEX registered inventory will be approximately 98 million ounces by First Notice Day at current drainage rates. If Shanghai reopens with the premium intact at $6 to $10, it sends a signal to every entity holding March contracts. That signal is that physical silver is worth materially more than COMEX spot. And if you are holding a March contract trying to decide whether to stand for delivery or roll forward to May, a strong Shanghai premium on reopening is going to push you towards standing for delivery. Here's the mechanism. If Shanghai is trading at 88 and COMEX is at 78 and you hold a March COMEX contract, you can take delivery at COMEX at the futures price, which will settle around spot, and then immediately arbitrage that metal to China at the Shanghai premium. That is a $10 per ounce arbitrage opportunity minus transportation and insurance costs. When that arbitrage exists and is wide enough to be profitable, entities with the capability to execute it will stand for delivery at COMEX specifically to capture the Shanghai premium. That increases delivery demand at COMEX. And increased delivery demand at COMEX when registered inventory is already at 98 million ounces against 429 million in claims is exactly the scenario that produces either unprecedented, eligible to registered conversions, significant spot price spikes, or cash settlement that destroys exchange credibility. Let me also show you what happened to silver prices during the closure window because this confirms the manipulation thesis. Silver tested lows around $75 to $76 during the middle of the closure period. Then in the final 3 days before reopening, silver started climbing. As I am recording this on February 23rd, silver is at $87.98, up more than $12 from the lows hit during the closure. That is not random. That is short covering. That is the entities who sold silver during the closure when there was no Shanghai bid, now buying it back before Shanghai reopens because they know the premium reasserts and they do not want to be short when it does. The pattern is mechanical. It happens every year, and it is happening again right now. Now let me address what this means for gold, because gold at $5,130 is not moving in isolation. Gold and silver are telling the same story through different lenses. Gold is up 67% year over year. Silver is up even more on a percentage basis despite the correction. Both metals are holding above levels that were considered impossible just 18 months ago. And both metals are doing this while every bearish narrative that could be deployed has been deployed. Speculative blow-off from the Treasury Secretary, falling knife from analysts, meme trade from CNBC. None of it stuck. The price corrected, consolidated, and is now moving higher again. That is not the behavior of a market that topped. That is the behavior of a market in a structural bull trend that experienced a leverage-driven correction and is resuming. Here's what I want you to take away from this. Tomorrow morning at 9 a.m., Beijing time, we get real data. Not analyst opinion, not bank forecasts, not media narratives. Real data from the world's largest physical silver market about what physical silver is actually worth when you need to take delivery. If the premium reasserts at $6 to $10, it confirms everything I have been saying about the paper-physical disconnect. It confirms that COMEX prices during the closure were artificial. It confirms that the structural case for silver is intact. And it sets up March 1st notice day 3 days later as the convergence point where Eastern physical demand and Western paper stress collide. If the premium collapses to $2 to $4 or lower, then I will be the first to say the bear case deserves more weight than I have been giving it, and we need to reassess whether the correction from 121 was more fundamental than just a leverage unwind. I am not married to being right. I am married to following the data wherever it leads, and tomorrow morning the data arrives. Here is my optimistic closing take. I think Shanghai reopens strong. I think the premium is intact. I think it might even widen because 8 days of pent-up industrial demand hits a market with 75% less inventory than a year ago. I think that strong reopening puts pressure on COMEX shorts who are positioned for lower prices and forces covering into first notice day. I think March delivers at elevated rates similar to January and February. And I think the combination of Shanghai premium and COMEX delivery stress produces the conditions where silver moves from current levels back toward $100 or higher over the next 60 to 90 days. Not because of speculation, because of supply and demand mechanics that are documented, observable, and playing out in real time. Watch 9 a.m., Beijing time Monday. Watch the first trades. Watch the premium. And then watch what happens Wednesday when COMEX first notice day forces every March contract holder to declare their intentions. The next 72 hours are the most important of this entire cycle. Stay positioned, stay optimistic, and trust the physical market over the paper narratives.